What if I told you that in the world of investing, your high IQ might actually be a disadvantage? What if the secret to building serious, life-changing wealth wasn't about being the smartest person in the room, but about being, well, a little bit dumb? It sounds completely backwards, I know. We're taught that success comes from being smarter, faster, and more clever than the competition. But today, we're going to unravel one of the biggest paradoxes in finance. We'll look at the hard data, the psychological traps, and the multi-billion-dollar bet that proves why the simple, boring, and so-called dumb investors almost always crush the so-called geniuses in the long run. Stick around, because this might just be the smartest dumb decision you ever make. Hey everyone, and welcome back to Finance Intel, the channel where we make your money make sense. If you're new here, consider hitting that subscribe button because our goal is to give you the clarity and confidence you need to build a better financial future without all the confusing jargon. All right, let's get into it. The dumb investor. Who is this person? It's not someone who is actually unintelligent. Not at all. In our story today, the dumb investor is a hero. They represent an approach to building wealth that is so simple, so hands-off, that the financial world, with all its complexity and fancy suits, often scoffs at it. But, as the old saying goes, he who laughs last, laughs all the way to the bank. To understand why this simple approach is so powerful, we first need to meet its opposite, the smart investor. Meet Smart Steve. Steve is, by all accounts, a brilliant guy. He aced his exams. He reads the Wall Street Journal over his morning espresso, and he can tell you the price-to-earnings ratio of a dozen different tech stocks off the top of his head. Steve believes he can beat the market. He believes that with enough research, enough cleverness, and enough speed, he can outsmart the millions of other investors out there. So, what does Steve's day look like? He wakes up early to check the pre-market futures. He hears a hot tip on a financial news show about a revolutionary new biotech company and immediately buys a bunch of its stock. He spends hours analyzing charts, looking for patterns that will tell him when to buy and when to sell. He's an active investor, and active is the key word here. He's always doing something, buying, selling, trading, reallocating. He feels productive. He feels smart. But here's the problem. Steve, despite his intelligence, is falling into a series of invisible psychological traps that sabotage his own success.
First up is overconfidence bias. Because Steve is smart in other areas of his life, he assumes he'll be a great investor. He overestimates his ability to predict the future. He thinks, I've done the research, I know this company is going to the moon. The reality? The market is a ridiculously complex system influenced by economics, politics, global events, and human emotion. No one, not even the most brilliant minds, can consistently predict its short-term movements. Next, Steve gets hit with confirmation bias. After buying that hot biotech stock, he subconsciously starts looking for information that confirms his brilliant decision. He reads positive articles about the company and dismisses any negative news as market noise. He's not seeking truth, he's seeking validation. This makes it incredibly hard for him to admit when he's made a mistake and cut his losses. And of course, there's the big one, fear and greed. Steve gets swept up in the emotions of the market. When a stock like meme stonk is skyrocketing, his gremlin brain kicks in. It's a classic case of FOMO, fear of missing out. He buys high, hoping to ride the wave. Then when the market takes a nosedive, the fear takes over. He panics and sells low, locking in his losses, telling himself he'll get back in when things are safer. The result of all this frantic activity? Steve's portfolio is a roller coaster. He might have a few big wins that he loves to brag about at parties, but his losses are often just as big, if not bigger. Plus, every time he buys or sells, he's racking up transaction fees and creating taxable events. He's working really hard, but his results are, well, mediocre. He's running on a financial hamster wheel. He's exhausted, stressed, and not much richer for it. Poor Steve. He tried to be the smartest investor in the world. He just didn't realize he was his own worst enemy. Now let's meet simple Sally. Sally is also smart, but she'll be the first to tell you she knows next to nothing about picking individual stocks or timing the market. She's a dentist, or a teacher, or an engineer. She's focused on her career, her family, and her hobbies. She doesn't have the time or the interest to watch financial news all day. Sally has accepted a simple but profound truth. She cannot predict the future, and she cannot beat the market. And that acceptance is her superpower. So what does Sally do? She follows a strategy so simple, it's almost laughable to the smart Steves of the world. Sally invests in the entire market. She does this by buying a single, low-cost index fund. Think of it like this. Instead of trying to find the one winning needle in a giant haystack, which is what Steve does, Sally just buys the whole haystack. For example, an S&P 500 index fund lets her own a tiny slice of the 500 largest companies in America. A total stock market index fund lets her own a piece of thousands of companies.
By doing this, Sally guarantees she will capture the average return of the entire market. She'll never have the thrill of picking a stock that goes up 1,000% in a year, but more importantly, she'll never have the agony of picking one that goes to zero. She has achieved maximum diversification with minimum effort. Her strategy is built on 4 pillars of dumb wisdom. Pillar number 1 is humility. Sally admits she doesn't have a crystal ball. This humility protects her from the overconfidence that plagues Steve. She doesn't bet on individual companies. She bets on the long-term growth of the overall economy. And historically, that has been one of the safest, most reliable bets you can make. Pillar number 2 is patience. Sally isn't investing for next week or next month. She's investing for the next 10, 20, or 40 years. She understands that the market will have good years and bad years. But over the long haul, the trend has always been upward. Her time frame isn't measured in days, it's measured in decades. This protects her from making panicked, emotional decisions based on scary headlines. Pillar number 3 is consistency. Sally puts her investing on autopilot. Every single month, the same amount of money is automatically transferred from her paycheck into her index fund. This is called dollar cost averaging. When the market is high, her fixed amount buys fewer shares. When the market is low and everyone else, like Steve, is panicking and selling, her same fixed amount automatically buys more shares at a discount. Without even thinking about it, she is systematically buying low. It's genius in its simplicity. And finally, pillar number 4, discipline. Or maybe we should call it productive laziness. Sally's secret weapon is that she does nothing. She doesn't check her portfolio every day. She doesn't react to the news. She just lets her automated plan do its work year after year. She tunes out the noise and lets the magic of compounding do the heavy lifting. So, who wins? While Steve was busy trading, stressing, and churning his account, Sally was watering her plants. And after 20 years, her simple, boring portfolio has not only caught up to Steve's, but has left it in the dust. She has more money and a lot less stress. Now, this story of Steve and Sally might sound like a nice little fable, but what if I told you this exact scenario played out in real life on a massive scale with billions of dollars on the line? Let's talk about one of the most famous bets in financial history. It's our real-life showdown between Smart Steve and Simple Sally.
In one corner, we have Warren Buffett, one of the greatest investors of all time. But for this bet, he's not playing the role of the stock-picking genius. He's representing Simple Sally. In the other corner, we have Protégé Partners, a firm that represents a group of Smart Steves, highly paid, supposedly brilliant hedge fund managers. The bet, made in 2007, was simple. Buffett bet $1 million that over the next 10 years, a simple, unmanaged, low-cost S&P 500 index fund would outperform a hand-picked portfolio of 5 different hedge funds. This was the ultimate test, the best of the best, the so-called smart money versus a dumb fund that anyone can buy. The hedge fund managers could use any complex strategy they wanted, shorting stocks, using leverage, trading commodities. The index fund could only do one thing, mindlessly track the 500 biggest companies in the U.S. The bet began right before the 2008 financial crisis. In the first year, the market crashed and the hedge funds did a little better than the index fund because they were able to use their fancy strategies to lose less money. The smart guys were feeling pretty good. But then the market recovered, and year after year after year, the simple index fund just kept chugging along. When the 10-year bet concluded at the end of 2017, the results weren't just a win for the dumb fund, it was a complete and utter blowout. The S&P 500 index fund had returned an average of 7.1% per year. The hand-picked portfolio of elite hedge funds, they returned a pathetic 2.2% per year. Over the decade, the $1 million invested in the dumb fund grew to over $854,000 in gains, while the smart money made only $220,000. It wasn't even close. Why did this happen? Two main reasons. First, the tyranny of fees. Those brilliant hedge fund managers don't work for free. They charge enormous fees, typically a 2 and 20 structure, meaning 2% of the total assets every year plus 20% of any profits. Steve's active trading also racks up fees. Simple Sally's index fund, on the other hand, had incredibly low fees. We're talking fractions of a percent. It might not sound like a lot, but over time, these fees act like a parasite, slowly draining your investment returns. Let's say you and your friend both invest $10,000 and earn an 8% return for 30 years. You pay 2% in fees, like an expensive mutual fund, and your friend pays 0.1% in fees, like a cheap index fund. After 30 years, your friend who paid the tiny fee would have about $98,000. You'd have only about $57,000. You lost over $40,000, 4 times your initial investment, just to fees. That's the devastating power of fees over the long term. The smart guys in Buffett's bet simply couldn't overcome the massive headwind of their own costs.
The second reason simplicity wins is even more profound. It comes from a study that the financial industry really doesn't want you to know about. For decades, a research firm called Dalbar has been studying how actual real-life investors perform. They compare the returns of the stock market itself, like the S&P 500, to the returns that the average investor actually gets. And the results, year after year, are shocking. Over the last 30 years, the S&P 500 has returned somewhere around 10% per year on average. The average investor, they've earned less than half of that. Why? Because the average investor behaves like Smart Steve. They are their own worst enemy. They chase hot stocks. They panic during downturns. They buy high and sell low. This difference between what the market gives and what investors actually get is called the behavior gap. The dumb investor, Simple Sally, avoids this gap entirely. By automating her investments and doing nothing, she guarantees that she gets the full market return minus her tiny fee. She closes the behavior gap simply by removing her own behavior from the equation. It turns out that the single most important factor in your long-term investment success isn't your intelligence or your ability to pick stocks. It's your behavior. It's your temperament. It's your ability to be a simple Sally, not a smart Steve. Okay, so this is all fascinating, but what does this mean for you right now? How can you put this dumb wisdom into practice and start winning the long game? The good news? It's simpler than you could possibly imagine. Here's the 4-step playbook for becoming a beautifully dumb and successful investor. Step 1. Choose your haystack. Decide to stop looking for needles. Instead, buy the whole haystack. For most people, this means choosing 1 or 2 broad, low-cost index funds. A great place to start is an S&P 500 index fund or a total world stock market index fund. These are available from providers like Vanguard, Fidelity, or Charles Schwab, and their fees are incredibly low. You are essentially placing a bet on the continued growth and innovation of the world's largest economies. Step 2. Put it on autopilot. This is the most important step. Set up an automatic investment from your bank account to your chosen index fund every single week, or every 2 weeks, or every month. Decide how much you can afford to invest consistently, and then automate it. This removes emotion and effort. It forces you to buy more shares when prices are low and fewer when they are high. You are mechanically enforcing good behavior.
Step 3. Tune out the noise. Once your system is automated, your next job is to do nothing. Seriously, stop checking your portfolio every day. It will only make you anxious and tempt you to tinker. Uninstall the stock market app from your phone's home screen. Stop watching the frantic financial news shows that are designed to make you feel like you need to do something right now. Their business model is clicks and views, not your long-term wealth. Your business model is patience. Step 4. Live your life and let compounding work. That's it. You're done. Go focus on what actually matters: your career, your skills, your health, your relationships. Let your money work for you quietly in the background. The real magic happens over decades, as your returns start earning their own returns. Albert Einstein supposedly called compound interest the 8th wonder of the world. Your job is to simply set it in motion and get out of its way. So why do the dumbest investors win? It's because they're not trying to win a game that is nearly impossible to win, the game of outsmarting the market. Instead, they're playing a different game entirely. It's a game of patience, humility, and discipline. They understand that true wealth isn't built by frantic activity, but by quiet consistency. They trade the adrenaline rush of a big short-term win for the deep, unshakable peace of mind that comes from a solid long-term plan. In the context of investing, dumb is a compliment. It means you've chosen a simple, proven path. It means you've conquered your own worst enemy, the emotional, impulsive, overconfident part of your own brain. It means you've decided to be the tortoise, not the hare. And we all know how that story ends. What do you think? Is this dumb approach something you could stick with? Have you ever fallen into the smart Steve trap? Let us know your story in the comments below. We read every single one. And if you found this video helpful and want more simple, no-nonsense explanations of how money really works, make sure to hit that like button and subscribe to Finance Intel. It's the smartest dumb click you'll make all day. Thanks for watching, and we'll see you in the next video.